Hi there, it's Friday the 12th of October 2018. I'm Steve Towers. Welcome to International Tax Bites, ITB. Let's get started. Let's start with the latest developments on the EU's proposed digital services tax. Austria, which is currently in the EU presidency seat, is considering an amendment which would overcome the cliff effect with the current design of the DST. Under that current design, the DST would apply to groups with total annual worldwide revenue above 750 million euros and total annual revenue from digital services in the EU above 50 million euros. It's that second prong, EU digital revenue above 50 million euros, which is the concern. If the group derives €1 above that 50 million euros mark, the whole of its EU digital revenue would be subject to the DST. That's the cliff effect. The proposal being considered by Austria is for the DST to apply only to the EU digital revenue in excess of 50 million euros. Some of the opponents of the DST have a new argument. 4 member states, the Czech Republic, Finland, Ireland and Sweden, have drafted a working paper which raises the issue of whether the DST would breach the double tax treaties which member states have with third countries. It advocates a study of this issue before adopting the DST. And it looks like Spain might go it alone. The government has announced that it will propose the introduction of a DST based on the European Commission model. It will apply to groups with total annual worldwide revenue above 750 million euros and Spanish digital revenue above 3 million euros. But it's not totally clear that this proposal would be passed by Parliament. The current government is a small minority government. That said, the idea for a DST in Spain was originally raised by the former government, which still represents a sizable block of votes in Parliament. It looks like GILTI might take over the world. A US Treasury official has said that the G7 has requested the OECD to prepare a paper on how CFC rules work around the world, with a possible view of developing a common global approach which includes a minimum tax on CFC's profits, just like the new US GILTI. He said, a level playing field in this area is important and therefore multilateral approaches to these problems are very important. Of course, such an initiative could provide an excuse not to expand the tax jurisdiction of market countries via a digital services tax or a significant digital presence rule. That won't be easily accepted. The OECD has released its annual report on MAP statistics. This latest report covers the 2017 year. For a copy of the report, please go to our website or app. The OECD has also released a report on the joint OECD-UN initiative called Tax Inspectors Without Borders. Under this initiative, qualified experts are deployed to developing countries to strengthen their ability to undertake tax audits and other compliance activities in regard to multinationals. The report indicates increased tax revenues directly attributable to this initiative are estimated at $414 million US, which represents a 100-fold return on the costs of the initiative. For a copy of this report, please go to our website or app. And the next OECD Tax Talks webcast is scheduled for next Tuesday, the 16th of October at 3 p.m. Paris time. To register for this webcast, please go to our website or app. The Australian Full Federal Court has decided an appeal in regard to the 2016 decision in the Tech Mahindra case, which you might remember raised a controversial double tax treaty issue. By the way, the company has apparently changed its name to Satyam, hence the different name for the appeal. The controversial double tax treaty issue is this. Can a double tax treaty lead to an increase, yes, an increase in the amount of source country taxation? In 2016, the court said yes, and now on appeal, the full federal court has agreed. Here are the relevant facts. The taxpayer is a company resident in India. The taxpayer has a branch, an Article 5.1 fixed place of business PE in Australia. The taxpayer provides software products and IT services to numerous unrelated customers in Australia. The IT services fall into two categories: services which are performed in Australia and services which are performed in India. Under the Australian domestic tax law, the income from the Australian performed services would be treated as Australian sourced and thus it would be taxable. However, the income from the Indian performed services would be treated as foreign sourced and thus it would be tax exempt. Now let's look at the impact of the Australia-India Treaty. Let's start with Article 12, the Royalties Article. As you know, it's India's treaty policy to allow source country taxation of fees for technical services. Sometimes that's achieved through a separate article in the treaty, and sometimes that's achieved through the Royalties Article. In the Australia-India Treaty, it's through the Royalties Article, and in fact, through the Royalties definition. The income flows from both types of services, the Australian performed services and the Indian performed services fall within the expanded definition of royalties in Article 12. However, the income from the Australian performed services was then sent to Article 7, the Business Profits Article, under the effectively connected rule in Article 12.4. And that Australian performed service income was considered to be part of the profits attributable to the taxpayer's Australian PE and was thus taxable under Article 7. Now let's focus on the income from the Indian performed services. That income was not effectively connected with the Australian PE, and thus it was not redirected by Article 12.4 to Article 7. Article 12 allows Australia to tax royalties which arise in Australia and to which a resident of India is beneficially entitled. The royalties were deemed to arise in Australia under Article 12.5 for the reason that the payers of the royalties, the various customers, were all Australian residents. And of course, the taxpayer was beneficially entitled to the royalties. So, Article 12 allows Australia to tax the royalties subject to a rate limitation. The specific wording in Article 12.2 is this: such royalties may also be taxed in the contracting state in which they arise, and according to the law of that state, but the tax so charged shall not exceed. Now, if the analysis stopped there, the conclusion would be obvious. Australia is permitted by the treaty to tax the royalties, but Australia has not done so under its domestic law, because the royalties are foreign sourced under domestic law, and consequently the royalties would be tax exempt. But here's the wild card. Article 23, which has the heading Source of Income, says this: 1. Income, profits or gains derived by a resident of one of the contracting states, for example India, which under any one or more of Articles 6 to 8, Articles 10 to 20 and Article 22 may be taxed in the other contracting state, for example Australia, shall for the purposes of the law of that other state, Australia, relating to its tax, be deemed to be income from sources in that other state, Australia. 2. Income, profits or gains derived by a resident of one of the contracting states, India, which under any one or more of Articles 6 to 8, Articles 10 to 20 and Article 22 may be taxed in the other contracting state, Australia, shall for the purposes of Article 24, relief from double taxation, and the law of the first mentioned state, India, relating to its tax, be deemed to be income from sources in that other state, Australia. So this means that the income from the Indian performed services, which Article 12 permits Australia to tax, is deemed to be income from sources in Australia for the purposes of Australian domestic tax law, for the purposes of Indian domestic tax law, and for the purposes of the treaty provision on relief from double taxation. As the treaty has been given the force of law in Australia, the deemed Australian source carries through to the Australian domestic tax law. And, so the argument goes, it causes tax to be imposed on the income from the Indian performed services, even though in the absence of the treaty, the income would be foreign sourced and thus tax exempt. And that's the analysis which was followed by the full federal court in this recent appeal decision. And the court's decision was essentially an application of the clear words of Article 23. As you would expect, the taxpayer argued that double tax treaties are not meant to impose tax. The court responded in this way. The taxpayer placed store on the generalised principle that tax treaties are, and can only be, exclusively relieving. That is, they are only ever shields, not swords, and not the grant of a standalone taxing power and independent imposition of taxation. The tax authorities did not disagree with the proposition that tax treaties do not grant a standalone taxing power or the independent imposition of taxation, or that the allocation of the tax rights they effect is permissive. They do not oblige the contracting states to tax. However, none of these generalizations establish the proposition that Article 23 does not operate according to its terms. And the court concluded, in summary, the text of Article 23(1) of the Indian Agreement is not ambiguous. Its effect is given paramount force by the International Tax Agreements Act. There is nothing in the context, object or purpose of the Indian Agreement or the International Tax Agreements Act which permits it to be read down to conform with a generalised assertion about the effect of tax treaties drawn from outside the text of the Indian Agreement. It should be noted that you can find a version of Article 23 in most of Australia's treaties. It reflects the policy of the Australian government to expand domestic taxation to cover the situations where Australia is permitted to tax under a treaty but does not do so under domestic law. Whether or not that policy is technically effective has been debated for some time in Australia. Based on the full federal court decision, that policy is technically effective. For a copy of this full federal court decision, please go to our website or app. And now for the developments in Asia Pacific. In Australia, the amendments to the Multinational Anti-Avoidance Law, the MAL, which can deem a PE to exist, have now been enacted. These amendments deal with attempts to circumvent the MAL by using partnerships and trusts. Notably, the amendments have retrospective effect from the 1st of January 2016. And speaking of Australia and tax avoidance, the Australian tax authorities have announced that their tax avoidance task force has collected 5.6 billion Australian dollars in extra tax in its first 2 years. For a copy of the press release, please go to our website or app. And also in Australia, the federal court has decided a revenue versus capital deduction case in favour of the taxpayer. The taxpayer, which carried on a gambling business, incurred upfront expenditure on acquiring a 10-year gaming machine entitlement for each of its slot machines. The court held that that expenditure qualified for an upfront revenue deduction. For a copy of this case, please go to our website or app. And now to India, where there has been a couple of interesting decisions by the Authority for Advanced Rulings, the AAR. In the first case, a UK company sold its shares in its Indian subsidiary to a third-party Indian purchaser for a cash consideration. In addition, the third-party Indian purchaser paid a further sum to the UK company for a commitment by the UK company not to compete with its former subsidiary for 3 years. The capital gains article in the India-UK treaty is unusual. It says that each contracting state may tax capital gains in accordance with the provisions of its domestic law. Well, the AAR held that the non-compete fee was not a capital gain, as the UK company did not transfer any asset to the Indian purchaser. Therefore, it was covered by the business profits article in the treaty. And as the UK company did not have a PE in India, it was exempt from Indian tax on the non-compete fee. And in the second case, a French finance company received various fees in connection with loans it made to third-party Indian borrowers. One type of fee was a front-end appraisal fee. This fee was charged before the loan was made and was charged whether or not the loan was made. The second type of fees, including commitment fee, cancellation fee, monitoring fee and amendment fee, were charged after and only if the loan was made. The AAR held that the first type of fee did not satisfy the definition of interest in the France-India double tax treaty, income from debt claims, because it was charged regardless of whether there was a debt claim. That meant that that fee was exempt from Indian tax under the business profits article. However, the second type of fees did satisfy the definition of interest, and thus Indian taxation in accordance with the interest article could occur. For a copy of these two Indian cases, please go to our website or app. Now to Indonesia, where e-commerce sales, particularly by small and medium enterprises, are booming. It's been reported that the government is planning to require domestic e-commerce platforms to submit details on a monthly basis of transactions undertaken by sellers. At present, it's not intended that the platforms would be required to withhold and remit tax. And in Singapore, a bill has been introduced into Parliament to impose GST on inbound digital services, effective the 1st of January 2020. This proposal was announced in the budget earlier this year. For a copy of the bill, please go to our website or app. And now for the developments in Europe. In Belgium, the government has proposed a number of anti-avoidance and anti-evasion measures. Two of these are worth noting. Firstly, the tax authorities will be prohibited from implementing tax rulings which relate to transactions with companies operating in jurisdictions on Belgium's tax haven blacklist. And secondly, a tax withholding obligation will be placed on Belgian companies in respect of share options issued to their employees by their foreign parent companies. Also, in regard to Belgium, the government had asked the European Commission for approval to not implement the interest restriction rule in ATAD 1, because its existing thin cap rules are as effective as the interest restriction rule. It's been reported that the Commission has denied this request and that the government will now implement the interest restriction rule. In Finland, the Supreme Administrative Court has held that a French FCPE fund, which is an employee investment fund, is objectively comparable to a Finnish personnel fund. Accordingly, no dividend withholding tax should apply on dividends paid by a Finnish company to a French FCPE fund, based on the EU's free movement of capital. An interesting aspect of this case is that the court held that the French FCPE fund is sufficiently comparable to a Finnish personnel fund, despite the fact that there is a substantive difference to the taxation of withdrawals from the two funds. A member of a Finnish personnel fund pays Finnish tax on withdrawals, but a member of a French FCPE fund does not pay French tax on withdrawals. The European Court of Justice has released a decision in favour of the European Commission declaring that France has failed to properly implement its 2011 decision in the Accor case. The Accor case concerned the difference in the French tax treatment under the then French law of dividends distributed by a resident subsidiary versus dividends distributed by a non-resident subsidiary. For a copy of this latest decision, please go to our website or app. In Ireland, the government has presented its 2019 budget. Here are the items that caught my eye. First and foremost, the government has strongly reaffirmed the 12.5% corporation tax rate. Ireland will implement the exit tax, which is required under the EU's ATAD 1, effective from the 10th of October 2018. That's quite a bit earlier than required. The start date, which is stated in ATAD 1, is the 1st of January 2020. I guess the government is concerned that some companies might rush for the door. The exit tax will apply to companies which move their residents out of Ireland. The tax rate will be 12.5% and it will apply to capital gains derived on a deemed disposal of assets at market value at the time of the residence change. As required by ATAD1, CFC rules will be implemented effective the 1st of January 2019. Interestingly, the government projects zero tax revenue from the CFC rules. There are two VAT changes worth noting. The VAT rate on digital publications will be reduced from 23% to 9%, which was recently permitted by ECOFIN. But the VAT rate on tourism activities will be increased from 9% to 13.5%. Well, strange days in the Netherlands. First, Unilever, which currently has a UK-Dutch dual entity structure, dropped its plan to convert to a Dutch-only structure due to significant pushback from UK shareholders. And second, apparently as a reaction, the Dutch Prime Minister announced that the government will reconsider its proposal to abolish dividend withholding tax, which was announced just a few weeks ago in the government's Tax Plan 2019. In Norway, the government has also presented its 2019 budget. There are some tax changes to note. The general corporate income tax rate will be reduced from 23% to 22%, and the special petroleum tax rate will be increased from 55% to 56%. Both changes are effective the 1st of January 2019. The existing restriction on interest deductibility, which is limited to interest paid to related parties, will expand to apply to all interest payments. However, the safe harbour amount of interest expense will be increased from 5 million Norwegian kroner to 25 million Norwegian kroner, which is about $3 million US. The definition of resident for companies has been amended after public consultation. Under the new definition, subject to one qualification, a company is resident in Norway if it is incorporated in Norway or if it has its effective management in Norway. However, the qualification is this: if a company is resident in another jurisdiction for the purposes of a double tax treaty between Norway and that jurisdiction, it will be deemed not to be a resident in Norway under domestic law. That qualification has been used in some other countries in the past, such as the UK and Canada. And Norway will slash its VAT rate on digital publications from 25% to 0, provided the EFTA Surveillance Authority gives its approval. In Poland, it's a question of whether the glass is half empty or half full. I'm talking about the long-awaited introduction of a tax-incentivised REIT regime in the country. Parliament is currently considering the proposal, which, if passed, would be effective from the 1st of January 2019. But here's the catch. It will apply to residential real estate only. Commercial real estate will be excluded. And now to Africa. In Angola, the government has announced that the introduction of the new VAT will be delayed until the 1st of July 2019. It was originally intended to commence on the 1st of January 2019. The new VAT will have a standard rate of 14% and it will replace the existing 10% consumption tax. And in Nigeria, everyone's watching with interest the twin disputes between the government and MTN, the large South African telecom company. 2 months ago, the Nigerian Attorney General's office claimed that the company owes $2 billion in back taxes. At about the same time, the Central Bank of Nigeria accused the company of illegally transferring $8.1 billion out of the country and demanded that that amount be returned. That's a lot of money for a company whose market capitalization is about $10.5 billion. Folks are predicting a negotiated settlement, which has happened before between these two parties. And now to the Middle East and Central Asia. Well, some things move very quickly in Bahrain. The bill to introduce 5% VAT from the 1st of January 2019 has been passed by both houses of parliament in record time. Bahrain will be the third member of the Gulf Cooperation Council to introduce VAT, after Saudi Arabia and the UAE. In Israel, the tax authorities have released 2 items of guidance. The first in regard to the tax treatment of a share buyback, and the second in regard to the tax treatment of a change in a company's capital structure prior to an IPO. For a copy of the items, please go to our website or app. And in the UAE, the tax authorities have released guidance on the VAT treatment of insurance. For a copy of the guidance, please go to our website or app. And now to the Americas. In Brazil, the tax authorities have issued guidance in regard to debt forgiveness and the federal social contributions levied on gross revenue. According to the guidance, the amount of the debt forgiveness will be treated as financial revenue for the borrower. Therefore, if the borrower is subject to the non-cumulative regime, the amount of the debt forgiveness will be subject to the federal social contributions at the rate of 4.65%. But of course, the big news in Brazil is the presidential election, where there will be a runoff on the 28th of October between candidates Bolsonaro from the right and Haddad from the left. Interestingly, it seems that they have some common ground in regard to tax policy. Both want to levy a tax on dividends, which under current law are generally tax exempt. And both want to simplify the myriad of indirect taxes. And in the US, a senior Treasury official has stated that proposed regulations are expected to be released in November on 4 tax reform topics: changes to the foreign tax credit, the BEAT tax, Section 163J interest deduction restrictions, and the anti-hybrid rules. And now for this week's treaty developments. We've had 2 treaties signed, 1 treaty enter into force, and 1 protocol enter into force. Well, that's the way it is this Friday, the 12th of October 2018. I'm Steve Towers. Have a great weekend. And now